Breaking news from Washington. Donald Trump's newly appointed Federal Reserve Chair, Kevin Warsh, is facing a massive economic test just weeks into his tenure. Next week, Warsh will lead his first regularly scheduled policy meeting, and the stakes for the American economy could not be higher. A scorching new consumer price index report shows inflation has topped 4% on an annual basis for the first time in 3 years. Combined with a surprisingly resilient jobs market, pressure is mounting. Analysts say the Fed's classic role is to take away the punch bowl when the party gets too hot, and that means interest rates may have to go up. But a rate hike would directly defy President Trump. The president has made it clear he expects lower borrowing costs to fuel growth, recently stating at Warsh's swearing in, "You get the interest rates down, everybody's going to be very, very happy." The Fed is designed to be totally independent of political pressure, setting rates purely on economic data. While the Fed is almost certain to hold rates steady next week, investors are increasingly betting on a rate hike before the end of the year. Some Fed officials are already signaling impatience, suggesting it may soon be appropriate to act. To manage the political fallout, Warsh may subtly alter the Fed's official statement, stripping out language that promises future cuts. If Warsh bends to political pressure and cuts rates now, experts warn the bond market could punish the move, driving mortgage and car loan rates even higher. Consumer sentiment has already plunged to historic lows as inflation remains above target for a 5th straight year. Next week, we will see if the new Fed chief chooses to satisfy the White House or protect the central bank's credibility. Stay with us as this story develops.